Financial Accounting, Chapter 10, Liabilities, both current and installment notes and contingencies, Part 2 of 3. So in Part 1, we did an introduction to current liabilities. We talked about accounts payable and accrued liabilities, and we had an introduction to payroll. Part 2, we're going to dig a little deeper into payroll, and we're going to start by recording payroll. So here's the information for a company called McDermott Supply. It's not just one employee that we've talked about in the Part 1 of 3, but it's the entire company. And their payroll, as you see here, is $20,000. Their office salaries are $5,000, and so their total payroll adds up to $25,000 here. And all of this is subject to Social Security and Medicare or FICA. And the state and federal employment tax is going to be based on $10,000. So let me make a quick pause here, and that is that as we talked about in Part 1, the employer has to pay the unemployment tax for both state and federal, but it's not paid on full payroll, only on parts. And this rate that the employer pays is based on how frequently they lay off employees. So companies that don't frequently lay off and therefore their former employees don't have to draw unemployment, don't have to pay as much unemployment. So here's our rates. Social Security, Medicare, state unemployment, remember again on a limited amount of payroll, federal unemployment. And these are the deductions that we've got in total for federal and state tax, retirement, and charitable contributions. So these are also, so here's what the journal entry looks like. You will do one for homework. You will not do one on the exam. They're complicated, but they're important that students with their books open see how difficult it is for an employer to record payroll. It makes you understand a little bit about the fraud involved with payroll because employers just don't like to have to do this. So they record their employees' expenses and their salaries. And then here are all of the liabilities. Every single one of these is a current liability. They've done the calculations for all the different withholdings. And finally, they've got salaries payable. Now, a lot of students go, why not cash? Well, that's because generally salaries payable is going to be money transferred into a separate bank account. And then an EFT, an electronic funds transfer, is going to transfer payroll straight into each employee's bank account. Very seldom do they write a check. But it's a good internal control to have a separate bank account set up to record payroll. The employer's payroll tax. Now, in the prior journal entry that we looked at, you saw the recording for the employee's pay and the withholdings that are required by law or at the request of the employee. This is what the employer has to pay. And you see the matching for FICA, Social Security and Medicare. You see that the employer also has to pay unemployment tax. So these are the payroll taxes, and this is the payroll tax expense. Note too that it's also considered a current liability, and each one of these is based on the rates that you were given in a prior slide. Employee fringe benefits are offered to many employees, things such as vacation pay, medical benefits, retirement benefits, and there often are journal entries recorded because these are expenses paid by the employer. So there's a journal entry to show that they have recorded that the employee has earned a day of vacation, whether they've taken it or not. It has to be matched in the period that it was earned. And in this course, we're not going to be recording these journal entries. Retirement or pensions. Pensions is more of a British term. They're called, retirees are called pensioners, but it's a cash payment to a retired employee. And the rights are accrued as they work for the most part based on the employer's plan. So individuals in the military have a very excellent plan for retirement. Individuals in the private sector oftentimes don't have as strong of a plan. Sometimes the private sector, such as the corporate world, the retirement money that is set aside comes straight from the employee's salary. In other organizations, the employer contributes some to the employee's retirement plan. Nonetheless, there are two types of retirement plans. The first one is a defined contribution plan. You're used to seeing it as a 401k, and the company invests contributions for the employee, and they both contribute to the plan, and usually it's based on the employee's working years. It just completely depends, and that's why we always tell anyone that's going to a new job to find out what the retirement plan offered is going to be, if any. It's better to at least have some withheld based on the employee's pay than to have nothing set aside at all, because Social Security just genuinely does not pay enough for most individuals to be able to allow them to live a comfortable lifestyle in retirement. A defined benefit plan is less frequently seen, but in this type of plan, the benefits of retirement are defined. For example, for some individuals, it may be that after 20 years of employment, the employee will receive 75% of the average of their last 5 years' pay. So the benefit of the retirement has been established by saying 75% of the average of the last 5 years' pay. And in this situation, the company pays the employee an annual fixed amount based on a specific formula, often service, age, past salary. These are extremely expensive. They're frequently occurring in companies that are unionized. But for example, you'll see still on lots of companies such as John Deere, you'll find a defined benefit plan. A little less frequently found because it's billions of dollars that have to be set aside to pay for employees that are retiring. Other post-retirement benefits could be received. This means that an individual has retired, but they still get all of these types of benefits. Individuals that have retired from the military or from government employment often will receive dental care, medical care, eye care, insurance, and so forth. So this ends, not slide 2 as it says down here, but this ends part 2 of 3. And we will move forward next into a discussion about installment.